Harsha Upadhyaya joins us, represents Kotak AMC. Harsha, would you call the market sell-off orderly, or this is a sign of more pain to come?
Good morning, Nikunj. I think clearly over the last 3 to 4 months, we have seen synchronous one-way moves across global equities. India was also part of it. At these current valuations, the markets bake in a swift recovery in the economy. What we see is a couple of factors. One, I think globally also we are seeing some bit of volatility on the downside in the last couple of trading sessions. So there could be some profit booking that's happening. So liquidity could be turning a little jittery at this point of time. Same could happen in India given high valuations. And also the expectations on swift recovery of the economy, those are receding day by day. Given all this, there is not much room for the markets to really go up from these levels. Either it will be a consolidation at around current level, or in the worst case, there could be some correction.
Harsha, can I safely assume that what is happening in Nasdaq will have a rub-off effect but not a ripple effect on in India? I mean, I want to discuss this point with you because psychologically we are always programmed to think that, oh my God, Wall Street is down, the Wall Street will be down. But the recent selling is happening in US tech. Should Indian investors pay attention to the sell-off in US tech stocks, or can we say that we are different because we don't have those same nature of stocks?
No, we should pay attention because if market leaders are taking a knock, then that also shows some signs of reversal, or early signs at least, I would say. So one has to take note of it. But I do not think that there is a one-to-one correlation between what's happening in Nasdaq and our own stock performances in the IT sector. I think the businesses are very, very different. The valuations are very, very different. And also given the fact that our economy is still reeling under COVID pressure, and there are many other sectors which have not come back to normalcy. At least in case of an IT sector, in the overall context of Indian listed space, there is a lot more resilience, there is a lot more focus on cash flow, and I think they have got huge cost levers. For example, the travel costs have almost come down to zero. And those are the levers that will play up during the next few quarters. While the revenue side may be still muted, but the velocity of deals are really improving. Not so much on the transformation deals, but really on the cost takeout engagements with IT users. I think there is good amount of velocity. So I think overall, our IT may not really fall as much as US technology, if at all US technology falls further.
Sure. Harsha, so what are the pockets of interest right now? Many believe that there are contra bets within construction, engineering, or for that matter, even real estate, which could be looked at right now. Are you of the same camp who believes that right now is the time to buy into these names with a 2 to 3 year perspective?
We are not really taking sectoral calls at this point of time because even within a single sector, the balance sheet strength and the ability to survive this disruption may not be similar. So to that extent, we are going more bottom-up in our approach. But if you were to look at the overall market, I think there are sectors which have shown more resilience, and also there are some sectors which have recovered quite meaningfully from the lows. I think in those spaces, the valuations are quite fair or maybe rich in some cases. So there is not much room for you to really make large amounts of money on a sustained basis in those segments. But there is another pocket where money could be made, but that would depend on the pace of recovery. While we do have exposure to industrials, while we have exposure to financials, for example, I think these sectors will show better stock performance only when things start to improve and become more visible to everyone. I think to that extent, it will be more a gradual improvement that we are looking at some of these sectors. Rather than immediate improvement. Then there is a third bucket, which is mostly beaten down stocks. For lack of any other definition, people call it value. But those stocks are down in terms of valuations because of a reason. That is what we believe. And there is no point on just betting on valuations and expecting those stocks to revive. But if we see any change in management approach in some of those stocks, or if there is any move to monetize some of the non-core assets, then I think there will be triggers for a value unlocking, and then we will look at those stocks. So broadly, this is what we are looking at market today.
Sure. In terms of the kind of timelines you're also looking at, Harsha, and I know that things are incredibly uncertain right now, but given the strategy that you're approaching markets with currently and the areas of growth that you're looking at, what's the kind of timeline you're giving things to sort of get back on track?
So I think looking at quarterly results, it doesn't give any confidence. Even if you were to look at the possible numbers that would come for September quarter, unlikely that you will have a very different take on the markets or on the stocks. So overall, I think financial year 21 is going to be a washout year in terms of earnings. Currently, the expectations are that from financial year 22 onwards, there will be a good recovery in our economy and also corporate profitability. If that were to come through, then I think there is some money to be made on financial year 22 basis. But otherwise, I think markets are fully priced in at this point in time.
Okay, fair enough. You know, within some of the cyclicals, industrials, the kind of revival story that we have been talking about, if you had to further slice that down, Harsha, what would then come out as a sliver where you think there is opportunity, you know, assuming, of course, that these are the more quality stocks, better balance sheets?
We do have exposure to many subsegments of engineering and cap groups. The idea being before COVID, this was one of the sectors which was really, really attractive in terms of valuations. They were quoting at a market capitalization of a proportion which was similar to, let's say, 2003-4 period, which was the beginning of the investment cycle. I'm talking about the market cap as a proportion to the total market cap. Now, with the disruption due to COVID, I think there has been a significant deferment in most of the projects that these companies undertake. Fortunately for us, most of our portfolio companies don't have much debt on their books and also well-run, have good management bandwidth. And we expect, already we are seeing some gradual restarting of projects. And as the execution pace picks up, I think these companies will come back. But whatever has been lost in the last 3-4 months is a loss, but it is going to come over a period of time since projects are restarting now. And the more important point is these will be the set of companies which will be able to really bid for new projects whenever the investment cycle takes off. There is some time before that happens, but whenever it happens, I think because of their balance sheet strength and how they have managed this crisis, they will be the ones to really bid aggressively for those projects and also be able to execute them. So I think overall, in terms of consolidation within the engineering and the capital space, I think those which have significant strength on the balance sheet and which have not taken big hit during this COVID phase will be the ones to watch out for.
Sure. Just look at your screens right now. Silver Lake investment values Reliance Retail at 4.21 lakh crore rupees. It's a sizable investment of 7,500 crore rupees. This was well in the market talks and now it's happened. A 7,500 crore rupee investment coming into Reliance Retail by Silver Lake. I just want to quickly bring up the Reliance Industries stock price as well. It's perked up in an otherwise weak market. 1% higher, 2130 thereabouts is where Reliance is currently trading at. So this investment by Silver Lake actually translates to about 1.75% stake in Reliance Retail. And Harsha, you know, the strategy of the group seems pretty clear. After Reliance Jio and reducing debt over there, it's now focused in Reliance Retail, which, you know, perhaps is going to be the first group entity to be listed separately.
True, I think there is a lot of focus on deleveraging, on monetization of the businesses which are currently unlisted. So to that extent, I think there is more to come, and we do have a large exposure to the company. But obviously, we are limited by the SEBI guidelines in terms of not taking an exposure which is equivalent to the weight of the stock in the index. We are limited to 10% of the portfolio in a single stock. So that obviously is a challenge, because in a market which has been so polarized, if you cannot really take an equal weight or an overweight on a stock which you believe is going to outperform, then obviously you have to make that up with some other stocks in some other sector.
Harsha, the question is that for an institutional investor like yours, who has compulsions of a minimum investment you have to make, how do you propose one can really play in the tech space? Because the only tech idea which comes to everyone's mind is Reliance. Apart from Reliance or apart from the bellwether names, what is the best way to perhaps bet on this entire tech transformation which is happening in the world?
Well, I think you may not have direct plays where the technology innovations are taking place in Indian listed space, but definitely you could look at the enablers for that transition. So there could be some of these IT services companies which are providing that transition. There could also be business models which are evolving, which are moving towards more towards a digital side. And if market is also moving in that direction, then obviously there is significant growth ahead. For example, credit card business is something that we really, really like. I think due to what has happened, people have stopped using or using less of currency notes and spending on the digital payments, through digital payments. And credit cards is definitely one of those businesses, and which has a very low penetration, which means that there is a long runway for growth. And also, if the entire portfolio is managed well, it can really have a very high ROEs in the business. So I think well-run credit card businesses will definitely be one of the areas that we will be keen to look at.
Okay, fair point. I think that is a sense in, an indication what is there on Harsha's mind. Harsha, now, one thought in the market is that stick to leaders, whether it is pharma, tech, or a combination of pharma, tech, and perhaps the new age businesses. The second thought is that go on the other end, which is you buy a beaten down, cheap, high dividend yield, a stock or a business which is below the intrinsic value, because like they say, uska bhi samay aayega. What would you do? I mean, would you be tempted to keep a balance? Would you avoid one? Would you take one? What are you doing?
Well, Nikunj, you have seen us managing money over the years, and our philosophy is pretty clear. We really do not like to take extreme positions, whether in terms of diversification or in terms of concentration or in terms of some of the sectoral views. So to that extent, at this point of time, while we do have some of the defensive or resilient sectors, as you mentioned, IT, pharma, some of those, we also have exposure to some of the sectors where things have not really turned into a normal condition as yet. For example, financials and industrials are the areas where we have really not seen a complete normalization. But we do believe that there is going to be normalization at some point of time, and the valuations of the companies that we are holding are really reflecting that, and hence we would like to remain within that basket. So clearly, it's a balance between some of the resilient names and some of the names where there can be an upside. Because today things are still uncertain. You really don't know which way the market is going to tilt. In case the recovery is going to be delayed, then you have to have the stability in the portfolio with resilient sectors in place. At the same time, if recovery starts to take momentum, then you need to have something in that bucket as well. So we have always been approaching investments from a slightly conservative or middle of the road kind of an approach, and that's what we are doing in these uncertain times.
Okay. So closing comments from you, Harsha. I'm going to ask you a difficult one, but sometimes I like to put you in spot. We are in September. Do you think the markets, in a sense, have peaked out for the year? Next couple of months, we may not see big price action.
See, Nikunj, prediction on short-term market movements is very, very difficult. But I would say that I don't know whether we have made a peak or not, but I think at least the upside seems to be not very high, purely from a fundamental perspective. It all depends on liquidity and sentiments. At this point of time, even liquidity and sentiments seem to be turning a little negative. So I would say that we are close to the peak for the year, if not the peak.
All right, appreciate your time, Harsha. Stay safe and certainly hope to see more of you going forward. Now, what do we have? Well, you definitely have a move away from banks to insurance. And I was reading a report yesterday on the morning. Pankaj just shared with me that what is happening to the private insurers and the growth there. And there are 2 or 3 standout gainers. One is HDFC Life, second is LIC. ICICI Pru in the life insurance space for the month of August somehow has not reported great data. I will try and figure out why. I just have the initial data points with me. What's looking strong because of that data, I think, is HDFC Life. Z has made a comeback, terrific comeback in Z. IT is holding on for the second day on the trot now. But what is not doing well, the broader market is in a bit of a disarray. The Bloomberg screen and my F&O page is indicating that there is more selling and more short built up rather than long covering. So Aisha, we may say that, okay, we are down, but Nasdaq was down 10% in 3 days. We are not down that much. So psychologically, the rub-off effect is something you cannot shrug off. This is not classic decoupling that they will go down, we will go up. But you have to understand that in this churn, where will markets settle? And I also see the following happening, Aisha, which is that whenever US markets will stabilize, you may not see that kind of a crazy leadership coming back in tech. What happened to US tech, I think, is the following, according to me, that these companies gained disproportionate market share, mind share, and portfolio share because of the COVID crisis. Now that American economy is normalizing, people are flying again. I see pictures of my friends. I see WhatsApp groups on they're taking holidays, some of them who live in US. I think the normalization will also lead to some rotation. So you may have a situation where tech stocks have fallen, but I don't think whenever they will recover, the recovery is going to be V-shaped.